recording. And again, officially welcome to the Unit 3 Financial Statements, Ratios, and Forecasting live event. Again, my name is Bruce Ferber, and I am being assisted this evening by the lovely and talented Dr. Frank Sampietro and Dr. Taft Dorman. All three of us are CIs on the finance team, so anytime you have questions about not just this material, but any of the material in the text, feel free to send us emails, give us a call, make appointments. We all work together and we do our best to try to make sure that our students are successful. Okay, so before we get started, I have a tradition for those of you who have seen the recorded cohorts. Hello, that's me. And yes, I am actually wearing a fleece. I live in Tampa, and for me it is cold. It is in the 50s. Actually, it's probably in the high 40s, which, yeah, I know for those of you who live in places like Vermont that got a foot of snow today, I'm whining like a little baby, and I know that, so I apologize in advance. Nevertheless, it is cold for me, so I am here. And even my dog, this is Cooper. He's the one who normally comes on camera. Cooper is an 11-year-old Bichon Poodle mix who is he's a super sweet dog. Aren't you sweet? Thank you, buddy. See? How sweet can you be? He's a rescue. I have two other rescues. They're about the same size. One looks like Cooper and one does not. They're super sweet. You may hear them in the background, hopefully not. Okay, I am now going to shut off my camera because you don't want to see my ugly mug for the entire hour and a half. So let me just do that. And we can get started. Okay, excellent. And as you see here, we are using our computer speakers. There is no dial-in number. Oh, Dr. Frank, I didn't see you saying Coop. Yeah. Okay, Sean, you are a way tougher person than I am. If it's in the high 40s, I'm crying like a little baby going, I want my mommy. So there you go. Okay. All right. So before we start, what movie is this from? This is Finance. 300. Excellent, Sean. So we have a tradition. If you haven't seen any of our recorded cohorts, and this is a Dr. Frank, Dr. Taft, and Bruce. I'm not a doctor. I'm just Ferbs. We have a tradition. When we ask questions and you get the right answer, we give you virtual Snickers bar to thank you for giving us the right answer. The challenge we have is until Amazon figures out a way to do it not virtually, but in real time, so you can actually have one delivered to you. It's going to have to be virtual, and I apologize. It's getting late. I would love to have that sugar rush right now, but we have to do what we have to do. Okay, let's get started. Here's our agenda for today. We're going to be going over each of the three modules within the unit. We're going over financial statements, and we should exactly 0 calories. I love it. We should go through this fairly quickly. I hope most of you are familiar with financial statements. If you've taken VYC 1 or even UFC 1, you should have some of this information. If you haven't, we will slow it down because this is important information for the PA and the OA. We're going to be talking about what are the financial statements that are important for this course. And we're going to look at the income statement, the balance sheet, the cash flow statement, and we're briefly going to mention statement of owner's equity. Don't think you'll have any questions on the PA or the OA on that, but I do want you to understand what they are in the event that a question does come up. We're going to move then to ratio calculation and analysis. We're going to talk about industry comparison and benchmarking, and what that means is when we do our ratio analysis, we need to compare those ratios to something. And we'll talk about what that something looks like and why it's important. And then we'll start talking about some of the key ratios, profitability ratios and margins. We'll focus a little bit on return on assets, liquidity ratios, debt management ratios, market value ratios, and then we're going to spend some time with your friend and mine, the DuPont equation. The DuPont equation rears its head. I almost said ugly head, but it's actually a really good ratio. Several times on the PA and the OA, both conceptually and in terms of calculations. Unit 3, if I haven't mentioned it previously, is one of the two quantitative units in C708, the other being Unit 4, which is very ably and capably taught by Dr. Frank. He leads that live event. Dr. Taft, by the way, leads the Unit 2 live event, does an outstanding job as well. We'll then talk about dividends, and we will briefly mention return on equity, which is ROE, ROA, of course, return on assets and growth. And then finally, we will end up with the last module, which is financial forecasting. And one of the challenges that I think I have with financial forecasting in this text is, for me, it does not bring together all of these concepts in a cohesive way. So hopefully I'll be able to do that for you tonight. We'll talk about percentage of sales forecasting, what spontaneous accounts are. You will get several questions on the PA and OA, so you'll have to know that. Very simple concept, but we will talk about it. We'll look at the sustainable growth rate using the DuPont equation and then using the basic form of return on equity. We'll do a couple of sample problems there as well. We'll briefly mention additional funds needed and then talk about discretionary funds needed. Discretionary funds or discretionary financing needed is another quantitative question on the PA and the OA, and you may also see a concept question related to that as well. And just to give a commercial that Dr. Frank has in our chat, tomorrow night, 7 p.m. Mountain, be there or be square. It's going to be at the same room that we are in right now. Dr. Frank will do his Unit 4 cohort. I will be there probably for the last 3/4 of it. I have a student call until about 9:15, but I'll jump in after that, and I'll be helping to man the chat. So I hope to see all of you there. Dr. Frank is way more entertaining than me and does a great job with Unit 4, which is another very difficult unit within C708. Okay, financial statements. There are 4 financial statements. Thank you, Dr. Frank. There are 4 financial statements that, if you're a publicly traded company, needs to provide. And what is a publicly traded company? Any company whose stock is traded on either the New York Stock Exchange or the NASDAQ. Apple, Walmart, Amazon, Google, they're all publicly traded companies, and the Securities and Exchange Commission, the SEC, requires the companies to publish quarterly and then annually with an annual report these statements: the income statement, the balance sheet, cash flow statement, and statement of owner's equity. And we're going to talk a little bit about each of the 4, focusing on income statement and balance sheet. Okay, what is the income statement? Well, the income statement is the statement that we see that has all of the company's revenue, which is also called sales. We use them interchangeably, and let me take a little digression. You will find in finance that we use multiple names for the exact same concept. Dr. Frank and Dr. Taft will post those in the chat as I go through when we happen to have a concept that has multiple names. So keep in mind, it's not you, it's us. It's not you, it's us. So we have revenue or sales, all of the company's expenses, the interest that they may pay if they have any debt, any taxes they pay. And when we subtract expenses, interest, and taxes from our revenue, we get what's called net income. And we also call that the bottom line. And you notice the bottom line is in black font. And the reason that the color black font is because back in the day, if you had a profit, you'd have black ink. And if you had a loss, you obviously had red ink. And that's where that phrase, by the way, comes from. Another useless fact that you will never ever need, but I had to throw it out there for you. Okay, this is what's important to know. You need to know the basic format of the income statement for both the PA and the OA. First, you're always starting out with revenue, again, or sales, minus what we call cost of goods sold, or COGS. Okay, cost of goods sold are all of the direct expenses that a company has that are related to directly producing the product or service that the company makes. When you subtract revenue from cost of goods sold, you get what's called gross profit or gross margin. I was in the technology industry for most of my career, so we always called it gross margin. Other industries call it gross profit. Then we subtract from gross profit or gross margin all of our operating expenses. These are also called SG&A expenses, sales, general, and administrative expenses. And these are things like salaries for the people who are not building or providing the product or service that we offer, rent, office expenses, things of that nature, utilities. Those are all SG&A expenses. And then we subtract out depreciation and amortization. We call these non-cash expenses, and we'll talk a little bit more about that. Most of you know what depreciation is. Everybody's heard the phrase, oh, I drove my new car off the lot and it lost, depreciated 20%. Not sure how that came about, but nevertheless, it is true that once you use something that is brand new, it no longer has the same value. So depreciation is really the accounting or economic use of whatever your car or whatever asset you have. Okay. When you subtract those out from gross margin, you get earnings before interest and taxes, which is also called EBIT, operating profit, or operating income, all the same. And please note Dr. Frank's note about revenue or sales. That is also something you see a lot in business. From EBIT, we subtract interest expense, and these are either from our notes payable, which is short-term debt, or long-term debt, and that equals our earnings before tax, EBT, minus taxes is our net income. So make sure you understand that flow because you may be asked a question about that. GAAP, generally accepted accounting principles. GAAP are really they're not hard, fast rules, they're guidelines that govern how the accounting folks record their transactions, okay? And the reason why GAAP is important is that there are certain principles that really guide how our accountants book certain entries. And in particular, expense and revenue entries are one that if you've ever been through a company audit, you know that they look very closely at how you are recognizing your revenue and how are you recognizing the expenses that drove that revenue. So that's an important concept. You will see questions on the PA and OA about the matching principle. And what the matching principle essentially says is when you recognize your revenue, you need to also recognize the expenses that were used to generate that revenue. And that's why it's called the matching principle. You're matching the expenses, normally your direct expenses, inventory, any manufacturing expenses, things like that, with the revenue that's recognized. Now you may say, wait a minute, what does revenue recognition mean? Well, what we mean here is this. Let's say you have a convenience store and somebody comes in and they buy a bottle of Diet Coke, which I have sitting in front of me, and they pay the $1.79 or whatever it is. You have just recorded that sale because they paid cash or they paid by debit or credit card, but you're getting that immediate payment for that good or service. Most companies, when they provide bigger goods or services, they usually bill their customers, and the customers traditionally have 30 days to pay, called net 30. The company does not recognize the revenue when they get paid, which may be in 30 or 45 or 60 days. They recognize the revenue when they invoice the customer. So that's why revenue recognition is not as clear as it may appear. And that's why the matching principle is important, so that a company doesn't recognize revenue but forgets to recognize the expenses. What happens if they recognize a lot of revenue and not a lot of the expenses? Their profit the net profit or net income is going to be inflated. And their auditors are going to come and give them a major league slap on the wrist. Okay, so matching principle, make sure you know that one. Fair market value. All this says is that the fixed assets in particular that are on the balance sheet and in the asset section of the balance sheet are not listed at the value that you may be able to sell it in the market today, but they're listed actually at the value that you paid for it less any depreciation or accounting use of it. Okay, so fair market value says the value of the asset is based on knowledgeable information, but that's not what's listed on the balance sheet. Fair market value comes into play other areas, but not when it's listed on the balance sheet. And finally, revenue recognition, which I've already talked about. Here's another topic that you will see at least one question on the PA and the OA, and that is non-cash expenses. So what's a non-cash expense? Well, let's talk about what is a cash expense. Our payroll, that's a cash expense. The company actually pays that out of its operating checking account. Pays its rent or its mortgage if it owns a building, pays its utilities. All of that are cash expenses because they're, you can think of it as writing a check. So a cash expense for you and I might be our internet provider. They send us an invoice and we have to pay net 20 days from when we get it. We write a check for that, we ACH it, we use our bank bill pay. However it happens and it comes out of our checking account. A non-cash expense is an expense where there's no cash that flows. You're not writing a check for the expense. There are three very common non-cash expenses, and you will see at least one or two of these on the PA and the OA. One is depreciation. We've already talked a little bit about that. That records the accounting use of any of the assets that we have. Again, very much like using our car, it is depreciating. Its value is being reduced as we use the car. Amortization. If you all had access to your microphone, I would have you say it with me because most people do not know how to say that. It is amortization. That's similar to depreciation, but the difference is depreciation is the accounting use of fixed assets, things that you can actually touch and feel and put your arms around. Amortization is the accounting use of what we call an intangible asset. And just like the name implies, an intangible asset is not something that you can touch or feel. Things like goodwill, which is really an accounting construct, or IP, which is intellectual property. So if you have a patent, that patent has value, but it's not something you can normally sell easily in the marketplace. You can't sell it. You can't really touch intellectual property other than the piece of paper that says, here, here is your patent. So that's considered an intangible asset, and we amortize its value just like we depreciate a hard asset's value. And then we have obsolescence, and this is something that you'll probably see this on the PA, not sure about some of the OAs, but what obsolescence is when something spoils or breaks. So if you're working at the Amazon warehouse, probably about 15 miles south of where I'm sitting in Tampa, and you're driving a forklift and you drop a pallet, well, Amazon's going to have to write that off, and that's a non-cash expense. If you're in a supermarket, Publix is the big supermarket chain in Florida and Georgia. So down here, supermarkets, like any supermarket, has produce. They have meat. Meat spoils, produce spoils, has to be written off. It's a non-cash expense. But understand that when you see that as a question on the PA and the OA, it is considered non-cash expense. Okay, any questions about the income statement? Let's move on to the balance sheet. So the balance sheet lists all of the company's assets, and as I have there, it's the stuff it owns or uses to generate sales and profits, and all the ways it has financed the purchase of those assets. So on the right side, we have liabilities, which is the company's debt, short and long term. And then we have owner's equity, which is both stock, an ownership interest in the company, and all of the company's accumulated net profits, which we call retained earnings. And as I say down there, the key to the balance sheet is it has to always balance, hence the name. So how do we state mathematically what the balance sheet is really all about? So the assets are what we own and what helps to generate sales and ultimately profit for the company. And the liabilities and the equity are the ways that we have financed the purchase of those assets. So super important equation number one, and this is a technical finance term, super important equation number one. This is not on the formula sheet that you will get with the PA and OA. You do need to know it because you will use it in the calculation of one or two problems. It's total assets equals total liabilities plus owner's equity. If you took an accounting class, this should be something that was probably drilled into you. But please remember it. This is sadly, another important slide. You will get a question or two that asks you to make sure that you understand what comprises assets, what comprises liabilities, and what comprises owner's equity. Assets are obviously current assets, and our current assets include cash, the Benjamins, accounts receivables. And what accounts receivables are, when we bill a customer and they haven't paid us, that creates an accounts receivable. When they pay us, that receivable goes away. So accounts receivable are nothing more than what we have invoiced our customers, but yet have not yet collected. And inventory. Inventory is another current asset, and that's obviously the stuff that we use to make our products and things like that. The second part of the asset section are fixed assets. This is the equipment we purchased, and this is really what helps us to generate the manufacture what we make so that we can sell it and then make a profit. So in fixed assets, we have gross fixed assets, and this is all the stuff that we have bought over since the history of the company began at the cost that we actually paid for it, minus any accumulated depreciation, any use of the assets, the accounting use, and that equals net fixed assets. Net fixed assets plus current assets equal total assets. Important to know that. Liabilities side, we have current liabilities. These are debts that we owe to people less than a year, where current assets are things that can be converted into cash within a year. We have accounts payable. So accounts payable is sort of the mirror of accounts receivables. And accounts payable is what we owe our vendors. So when we get that internet bill from our internet provider, that is an accounts payable for you and I, because we have to pay that in order to continue to have internet so that we can continue going to school or working in some of our cases. So it is an accounts payable for us, and it's an accounts receivable for the internet company. Accruals, don't worry about. We actually don't use them anymore in this class, which is awesome. And then the last current liability is notes payable, and these are nothing more than short-term debt. Current liabilities plus long-term debt is any debt that we owe that we pay for more than a year. Total of current plus long-term debt is total liabilities. And then we have owner's equity, which is common stock. That's the ownership in the firm. And retained earnings. And again, retained earnings are nothing more than the historical accumulation of all of the net incomes that the company has earned over time. And if you look in the chat, both Frank and Sean are having an excellent discussion about retained earnings. So the key to retained earnings is it's not cash. It is, I call it an accounting construct. The retained earnings are really what helps to make the balance sheet balance. Okay. All it is nothing more than an accounting accumulation of net income over time. It is not cash, and that's a really important concept, because you will see answers to balance sheet questions on the PA and the OA that specifically imply retained earnings as cash. And Dr. Frank is doing a great job answering those questions, so feel free to jump in there if you do have questions about retained earnings. Working capital. Working capital is nothing more than a measure of how liquid our business's current assets and current liabilities are. Okay, we calculate working capital, net working capital, as current assets minus current liabilities. Obviously, if we have more current assets than current liabilities, we have enough cash, we have enough liquidity, as we call it, the ability to create cash by selling our accounts receivables, called factoring, or selling our inventory, to get the cash needed to pay our current liabilities, which are traditionally going to be accounts payables. That's how we measure liquidity, and that is essentially what working capital is. For those of you who don't know me very well, I was a CFO for 17 years before I joined WGU, and working capital was something I looked at every single day because it is true that cash is king. And net working capital was a really important concept in terms of the liquidity of the businesses that I managed. Okay, so that's the balance sheet. We've talked about the income statement. Questions? I wish I was the king of cash. I teach now, so I'm not the king of cash anymore. But I am happier, but that's a good thing. So we're going to quickly go through cash flow statement and then statement of owner's equity, and then continue on our merry journey. Cash flow statement, the cash flow statement has one use and one use only, and that is to explain the change in cash from one period to the next. It sounds like it's not a lot of use, but I will tell you the cash flow statement is a very important statement when it comes to looking at the financial health of a firm. So what's important here is that there are three sections on the cash flow statement. Cash flow from operations, and that's essentially your income statement. What have you used from an operations standpoint? Cash in and cash out. And cash flow from operations is can be either one, right? Cash flow from investing. And cash flow from investing, and I guess I'll move the slides because I talk about that. Cash flow from investing is not usually a company investing in another company's stock or things like that. It could be. They could invest in commercial paper or some short-term investments. A lot of companies that have excess cash have their cash swept out of their account every night and invested in very short-term instruments that pay very little but better than zero. So that would be cash flow from investing. But traditionally, cash flow from investing looks at how the company invested in fixed assets, in equipment, machinery, and things of that nature for the current period. So that's really what we look at when we talk about cash flow from investing, especially for most firms that have operations. And finally, cash flow from financing. This is how much additional net short-term debt, long-term debt we have, net being what we've borrowed minus what we've actually paid back. It also looks at preferred stock and common stock that we've either sold to the public and generated cash for us, or we have repurchased our stock where we buy back our stock, or what we borrowed from a bank or something like that. Cash flow from financing also subtracts any dividends that have been paid to our shareholders. A dividend is a payment based on the number of shares that you have. It's usually quoted on a per share basis of a certain amount, and you get paid that every year for every share that you own. And lastly, we come to the statement of owner's equity. Similar to the cash flow statement, the statement of owner's equity has one use in life. Explain the change in the owner's equity section of the balance sheet from one period to the next. You probably will not see anything on the PA and the OA on this, but if you do, these are the things you normally find on the statement of owner's equity. Net income from the income statement, any dividends that are paid, any stock that has been issued or redeemed, the stock buyback, or any other items that have affected the firm's equity. Questions on financial statements? Hopefully a lot of that was review. If not, and you want a little bit more information on financial statements, I strongly recommend make an appointment with your CI, with Dr. Taft, Dr. Frank, or me, and we'll be more than happy to go over that with you. Okay, no questions. Let's move on to ratio analysis, and we'll be spending some time here. So what is ratio analysis? Ratios are nothing more than the ability for us, those of us who are finance geeks especially, to understand how our company is doing financially, either versus our peers in our industry or what our performance has been over the course of time. Ratios should not be calculated by themselves in a vacuum because without something to compare them to, they don't make a whole lot of sense. You really can't do a lot with them unless you're comparing them to something that makes sense, like some kind of a benchmark, and we'll talk about that. So there are 5 main categories to ratios. You do need to know the 5 categories just in a general sense. At this kind of level is fine. Profitability ratios, and these measure how profitable the company is by how they use their assets, how they use their equity, how effective they are in doing that to generate profits for the company. Liquidity ratios, how much cash is available for the company to pay its debt, how liquid is the firm's assets, for example. Debt ratios, the firm's ability to pay its long-term debt. Market ratios, you won't see a whole lot on the PA and OA on this, but you should know at least what they are. These measure the return and the value of the company's stock, and also include the cost of issuing that stock. One of the key market ratios you probably have heard about is the price-earnings ratio, the PE ratio. Dr. Frank and Dr. Taft have both worked in the financial services industry and can probably tell you way more about the PE ratio than you want to know, but they are both experts in understanding that. And finally, efficiency ratios and how effective or efficient we are as a company in using our assets to generate either sales revenue or net income. Benchmarking. This is the key to ratio analysis, and I truly mean this. If you ever worked for me and you try to give me a ratio that didn't have a comparison to either the company's past or a peer in our industry, I probably would have thrown you out of my office, because it has zero value to me or anybody else. So the key to benchmarking is to find companies, either our peers in our industry or industry averages, and compare our ratios to those ratios, because that's comparing apples to apples. And what that does is it gives us a much better idea of how we're doing financially vis-a-vis our industry or our peers. Some of you may be thinking, well, how do I get industry averages? You can see there, Dun & Bradstreet publishes, I believe it's quarterly, industry ratios for so many industries. And even within the technology industry, they really broke it down and got very granular. So I was able to get my industry averages and look at how my companies were doing relative to the rest of the industry. The other thing that's really important is looking at what we call trend analyses. A trend analysis is nothing more than how are we doing over time? How has our return on equity changed over the last 5 years? That gives us some indication whether we're moving in the right direction, whether we're moving in the wrong direction, and if we're moving in the wrong direction, what do we have to do to change that and get it back on track? So trend analysis is also a very important part of benchmarking. But again, the key to benchmarking is this is what we compare our ratios to give us an indication of how we're doing financially. Profitability ratios get a lot of positive press because they really give a great indication of where the company is from a profit perspective. And these are some of the ones you might see. The last three actually are the ones that you see quite a bit. Operating margin, it tells us how much of our company's sales on a percentage basis are being generated by our operating profit. Gross profit margin, which is also called gross margin, on a percentage basis, how much of our company's sales are generating that gross profit. Net profit margin, you can see the theme here. Anything with a margin is comparing, in this case, net profit to sales. The two most important, in my opinion, profitability ratios are return on assets and return on equity. Return on assets, which is calculated as net income divided by total assets, tells us how effective is the company in generating net income, net profit, in using its assets. Similarly, return on equity, which for me as a CFO was the most important ratio, told me how effective we were as a company in using our shareholders' contribution to us with the dollars that they had purchased our stock in generating profit. And oh, by the way, shareholders really care about return on equity. I can tell you that for a fact. Liquidity ratios, again, we have two that we see quite a lot, the current ratio and the quick ratio, also called the acid test ratio. Not sure why. For those people who grew up in the 60s, you hear acid test and you get a different vibe, but trust me, that's not what they mean. So current ratio is current assets divided by current liabilities. What it's really saying is, can the company pay its short-term debts using short-term assets? Obviously, if current assets are greater than current liabilities, you're going to have a current ratio of 1 or greater, and that's usually a good thing. You see the book talk about a current ratio of 2 or 3. I forget what they have as a benchmark. That tells you whether or not the current ratio is good. That is not true. You need to compare your current ratio with your industry average. That'll tell you whether or not you're doing a good job in terms of liquidity. The quick ratio does nothing more than take the current ratio and subtracts out of current assets inventory. The reason, Electric Kool-Aid, that's right, Electric Kool-Aid acid test, Ken Kesey, I actually read that book. Anyway, the quick ratio takes out inventory from current assets because inventory is not as liquid as selling accounts receivables, which we call factoring, or certainly cash. You can sell inventory, but you probably won't get anywhere near the value of your inventory. So the quick ratio, in my opinion, gives a better snapshot of how liquid the firm really is. Debt ratios, again, very simple. Can a company pay their long-term debts using its total assets? In virtually every ratio, and this is important, the bigger the ratio, the better. So a return on equity of 40% is way better than a return on equity of 10%. Except when we talk about debt ratios. The smaller the debt ratio, the better. And you will see a question on the PA that relates to this. Just saying. Market ratios, again, I'm not going to talk too much about it. The price-earnings ratio, Dr. Taft and Dr. Frank can tell us a lot more about why higher PE ratio means that that firm is more expensive and why. But PE ratios are bandied about quite a bit in the press. Price to book, how much value is management creating from its asset? Obviously, like most ratios, the higher the better. And now we're going to stop. Or I see a couple of folks typing because we're going to get to, excellent point, we're going to get to the DuPont equation. Correct, Nicole. Debt ratio low and everything else high is good. Exactly. Dr. Frank's point is very important as well. PE ratios are also industry specific. And again, because I was in the technology industry, we tended to have companies that had higher PE ratios than companies like a Walmart or slower growing companies. You know, traditionally in technology, we had lots of high-flying companies that did incredibly well and grew very quickly, so they obviously had way higher PE ratios than some of the more slower growing manufacturing industries. Okay. The DuPont equation. I promise you, you will see this on the PA and the OA, both the concept and the calculation. So we're going to spend a little time going through both. The DuPont equation was developed by a guy who worked for DuPont, the chemical company. Thanks to Frank for sharing that with me. And it was a way to break the return on equity calculation into components, 3 different ratios, such that CFOs like me could then have a better understanding of how we can increase our return on equity. So the normal return on equity equation is net income over total equity. As a CFO, if I wanted to try to increase our firm's return on equity, the only thing I could do is reduce expenses, which most CFOs run their organizations lean and mean anyway, so you're running pretty low in terms of your expenses. But that lower expenses with the same revenue gives you a little bit more net income, which increases your return on equity. But if you're gonna, if you know, and oftentimes I will tell you that I would get paid part of my variable compensation, which is my bonus, was predicated on increasing return on equity. And if the only thing I could have done was cut expenses, that would not have cut the mustard, frankly. So we used in the real world the DuPont equation extensively to look at how can we generate a higher return on equity. So the DuPont equation that you see there on the screen consists of three different ratios. The net income margin, net income over sales, times sales over total assets, called the total asset turnover, times total asset over total equity, which is the leverage multiplier. The actual ratio formulas for net income margin times total asset turnover times leverage multiplier will be on the formula sheet on the PA and the OA. What will not be on the formula sheet are the names of those three ratios. So what you see there at the bottom of that slide, you want to make sure you remember that. That's something important to memorize because that'll give you 2 to 3 questions correct on the PA and the OA. And Dr. Frank makes a great point. Net income margin is also referred to as net profit margin or just net margin. Exactly. Excellent. Thanks. So again, understand that you need to know the names of these three ratios. You don't need to know the formulas for them because you'll get that. Just need to know these names. And this is the game plan. Learn it, live it, and love it. Okay. This is what you'll see on the formula sheet. Return on equity equals net income over sales times sales over total assets times total assets over total equity. You don't have to worry about this. So, basic concept, it gives us three different ways to try to affect a change, a positive change, an increase in return on equity. That's the concept, pretty straightforward. What you see more of, you'll see some problems. You'll see some quantitative or math problems. So here's a practice problem. We'll go through the first one together, and then we'll have another one where we will see who will earn the next virtual Snickers bar. Okay. So what I'm going to do is I am going to get out of this, and I am going to share another part of my screen that actually has, as you can see now, hopefully you can see this, and let me make sure that I okay, there we go. This is our handy dandy BA2 Plus calculator, and we're going to use this just to calculate all of our problems today so you can see what to enter, assuming you do have a BA2 Plus calculator. Okay, so practice problem number 1. NSG Corp. NSG stands for Next Stop Graduation because all of you will graduate. Has sales of $35 million, net income of $2.5 million, total assets of $44 million, and a leverage multiplier of 0.95. What is their return on equity? Okay, well, this is a problem that you will see on the PA and the OA, guaranteed. So the question becomes, how do we calculate this? Come on, David, you're not going to eventually graduate. You're going to graduate. Come on now. Okay, so how do we calculate this? I will tell you that if you've heard any of my live event recordings or you've been to a live event of mine, I have a very small brain and it's already full of useless knowledge, as you probably have already seen. So I have to take problems like this in bite-sized chunks because that's the only way that I can solve these kind of problems. You know, if you approach a math problem and try to solve it all at one time, that's a recipe for disaster, in my opinion. So let's take it step by step. You don't have to do it the way I do it, but my recommendation is let's take it step by step and see how we would solve this problem. Okay, so here's our problem. Sales are $35 million, net income is $2.5 million, total assets are $44 million, everything that's here, and we're given a leverage multiplier. If you remember, that's one of the DuPont equation ratios. we're given the leverage multiplier of 0.95. Okay, so here is a great clue for when you would use the DuPont equation. Anytime you see a problem and at least one of the three ratios that comprise the DuPont equation, net income margin, total asset turnover, and or leverage multiplier, as we see here, are listed in the problem, you're going to use the DuPont equation. So since that is the case here, I would pull out my handy dandy formula sheet and I would know that the DuPont equation equals, you can see it down here, even though the answer is here, net income margin times total asset turnover times leverage multiplier. So I'm given leverage multiplier, which tells me I have to calculate net income margin and I have to calculate total asset turnover. And once I do that, I can plug and chug all of these numbers together and get the return on equity using the DuPont equation. Okay. So, since I know I have to calculate net income margin first, and since I also know that thanks to my formula sheet, it's net income divided by sales, I have net income here, 2.5 million, and I'm just going to drop the millions. Okay, so 2.5 divided by sales of 35 million. 35 equals 0.0714, which is also 7.14%. And yes, Jessica, it's always a percent. That's a great question. So that's my step one, calculated my net income margin. Step two, calculate my total asset turnover. Well, again, my formula sheet tells me total asset turnover is sales, 35 million, divided by total assets, 44 million, equals 0.7955, which here I've just rounded to 0.80. So now I have my net income margin, 7.14%. I have my total asset turnover, 0.8. And I'm given my leverage multiplier of 0.95. So at this point, we can do what I love to call plug and chug. I could have just said plug, but you can imagine where the chug comes from, and we won't go there, but you can use your imagination. So we can plug and chug into our DuPont equation, multiplying 0.0714, again, which is 7.14%, times 0.8 times 0.95 equals 0.0543, which is 5.43%, and that is our return on equity calculated using the DuPont equation. Questions? Okay, I'm moving on until you tell me otherwise. Here's another problem, and I'm going to let you guys calculate this one. NSG Corp has a return on equity of 15.2%, net income margin of 7.2%, and total asset turnover of 1.5. What is the leverage multiplier? So this is a little different. The last problem, we had to calculate return on equity. This problem, we have to calculate the leverage multiplier given the return on equity. I will tell you, the last problem you will absolutely see on the PA and the OA. This kind of a problem you will also absolutely see on the PA and the OA. If you can solve these two types of problems, you should have no problem getting a couple correct on both of those assessments. I see Nicole typing, so I'm going to wait. Oh, show off. Nicole is absolutely right. So you get the virtual Snickers bar. Excellent. Excellent. Let's figure out how to do that. Dang, you must have had a good course instructor, Nicole. Man, that's good. I'm waiting for her to type because, yeah, Nicole and I worked together. That's why I was able to say that. Okay, and we actually had an appointment this afternoon. So let's look at how we do this. Now, keep in mind, this type of problem is when you are given the return on equity, and you have to find one of the other ratios. There's a two-step hack that I'm going to give you that will always work in solving these kind of problems. But again, I don't want to emphasize enough that you have to be given the return on equity to use this this little hack I'll give you. So step one of two steps. I would ignore the plug all the values in. That's just for me because I'm a lot slower than the rest of you. Step one is multiply together the two ratios that are not, repeat, that are not the return on equity. So that would be the step two there. What does that mean? Okay, we're given a net income margin of 7.2%. That's 0.072. I'm going to multiply that by the other non-return on equity ratio, 1.5 times 1.5 equals 0.1080. Okay, that's step one. Step two, divide that product into the return on equity. So what that means is 0.152, or return on equity, divided by 0.1080 equals, of course, I think I hit something other than what I should have. Let me try that again. 0.152, I apologize, I fat fingered something, divided by 0.1080 equals, that's better, 1.4074, which Nicole correctly rounded to 1.41. So the leverage multiplier in this problem is 1.41. Questions on this second form of the DuPont equation? Excellent. Either you're all right with me or you're all lost. Not surprising, given the beginning of this live event, I have a dog slide, right? Are there any questions? That's a beautiful beautiful dog right there. Okay, no questions. Let's move on. So we're going to take a break from the math and talk about dividends. So let's kill this one right now, and we're going to stay here because we're going to have some more math in just a minute. What are dividends? Dividends are payments made by a company to its shareholders to give them a portion of the company's net income. And this is important to understand. As I mentioned a little while ago, dividends are normally paid on a per share basis, so you $3 per share. So if you own 100 shares, 100 times $3, you get $300 every year from the company. Excellent. Taft has an excellent comment in the chat. So this is what's really important to understand about dividends and net income. So the net income we know from the income statement is really nothing more than our total profit after we have recognized all of our expenses and subtracted them from our sales or revenue and reduced that by interest and taxes. Okay. That bottom line, that net income, we can only do two things with that. Well, we can pay our shareholders a dividend with that, or we can retain them in the firm, and that's called retained earnings. Can't do anything else with net income. Exactly, Kaylee. Money paid to shareholders, that's what a dividend is. That is a great, succinct definition. Excellent. Why are dividends important to know about? A, because you'll see this in a calculation in a few minutes, and B, you do need to understand that with net income, these are the only two things you can do with them. Okay, so if there are only two things you can do with net income, pay them as dividends or retain them in the firm, retained earnings, we can calculate that, right? B, the dividend payout ratio, is dividends divided by net income. Okay, and you will see this formula on the formula sheet. The retention ratio is 1 minus B because you can either pay dividends or retain. So B is the dividend payout ratio, 1 minus B is the retention ratio. Again, something to make sure you know and understand. So what's the relationship between return on assets, return on equity, and growth? Okay. Talked about the definition of return on assets, talked about the definition of return on equity. Here is really where growth comes in when it comes to these two. Return on equity is what we're going to talk about in just a minute. The company's sustainable growth rate is based on. The sustainable growth rate is, again, another real-world concept that we used quite a bit, and you'll understand why when we talk about it in just a minute. Okay? Questions so far? Yes, it does get even better than this. Okay. We're going to talk about financial forecasting, and as part of this, we're going to talk about something called the sustainable growth rate, which, again, very important concept. You need to understand both the concept and the math that comes with it. You will see one sustainable growth rate problem on the PA and the OA. So as a firm, one of the things we do in finance in particular is forecasting, right? Forecasting and budgeting. Those are the two of the main corporate finance functions that we normally look at. So on the forecasting side, how do we forecast what a company's financials are going to look like in the next year, in the next 2 years, in the next 3 years? The industry standard way of doing this, and I don't know if I would say industry, that was probably a poor choice of words, but a standard way of doing forecasting is using what we call percentage of sales forecasting. And all percentage of sales forecasting is looking at the growth in sales between 1 year and the forecasted year, and then applying that growth rate to any account on the income statement or balance sheet that is affected by sales. Okay? Any account that is affected by the change in sales is called a spontaneous account. Very important. You will see at least 1 or 2 questions on the PA and the OA, so you need to know what a spontaneous account is. And simply, it is any account on the income statement or balance sheet that changes as sales changes. That's it. We use percentage of sales not only to forecast our financial statements, which are really important. Obviously, if you have shareholders, they want to see information like that. Certainly, executives want to see information like that. But it also gives us an idea of how much additional financing we may need to support that growth in sales. So what does that really mean? Well, if you're a manufacturing firm, for example, and your sales staff has forecasted you're going to grow sales by 50%. You can't see my face, and I'm making a face because traditionally what we did is we took a sales team's forecast, divided it in half, and that was actually the forecast that was probably pretty close to what's going to actually happen. We want our sales folks to be optimistic, so we never want to discourage that. However, sometimes they are overly optimistic. So we get their sales forecast, and what we ultimately want to be able to understand is what additional resources are we going to need to support that growth in sales? So again, if we're a manufacturer, what additional equipment, if any, are we going to need to support a 50% growth in sales? Well, if you're a manufacturing firm and you have 50% of excess capacity, you're probably going to lose most of your management staff, because that's way more capacity than you should have paid for. So the assumption really is that you're going to have to buy new equipment to support that growth in sales. The percentage of sales forecasting method ultimately gives us the opportunity to understand what equipment we need to buy, how much is it going to cost, and how are we going to finance the purchase of those additional pieces of machinery. And that's the key to the other part of what we do here with our financial forecasting. This gives us ultimately an understanding of how much are we going to need in order to grow, in this case, in this example, 50%. You'll see in a few minutes when we talk about this why this is important. So how do we calculate the growth in sales? Okay. And it's not just a sales growth rate. This is any kind of a growth rate, any kind of rate of return. You know, for example, if you buy a house at one price and sell it at a higher price, you'd like to know what your return is. Here is a formula that is not on the formula sheet, but this is a way to calculate any kind of growth rate. It's this year's the forecasted sales divided by last year's sales minus 1. Okay. You want to commit that to memory? You can. I'll show you a faster way if you have your BA2+. So here's an example. 2017 sales were 50 million and we're forecasting 2018 sales to be 60 million. That's not a bad growth rate. So what's the sales growth rate? And again, you can say 60 divided by 50, which is 1.2 minus 1 is 0.2, which is 20%. Okay. But if you don't want to remember that formula, let's use our handy-dandy calculator to calculate that. The second key, as most of you know, is like a shift key. If I hit the second key, you notice the second is over there, and then the number 5 key. Above the number 5 key, you see a little triangle and a percent. The triangle is called delta, and of course, which means change, and of course, percent is percent. So change in percent. This is where it will calculate for us the growth rate. You see when we do that, it says old equals. Well, what's the original sales? 50 million. So I'm going to type in 50 and hit the enter key, very important, and then the down arrow, because this will move us to the next menu choice. What's the new value? 60 million. 60. Again, the enter key, and the enter key is important. That gets the value into the calculator. And then the down arrow moves us to our next menu choice. Percent change, it's 0. Well, that's wrong. And the reason why the percent change is 0 is because we have to compute it. So when we hit the compute key, percent change is 20%, which is the answer. That way, you don't have to memorize this formula, and you have the calculator do all the heavy lifting. Questions on using the delta percent function in our calculator. To clear it, I'm going to hit second and then the clear key. And you can see it's all cleared out. And I'll clear that. And David is typing while I move to the next slide. Okay. While he continues to type, Frank and Taff will take care of that. Here's a problem, and let's see who gets the next virtual Snickers bar. NSG is projecting sales to be 125 million next year. This year's sales is 85 million. What is the sales growth rate? Second key, and then the number 5 key, David. And again, you can see that triangle percent. That will. Dang, Nicole. Excellent. Excellent, Jessica. Woo! You guys are cooking with gas. That's all I got to say. This is a sharp bunch. Yes, nice work all is right, Dr. Frank. That's awesome. So let's see how we do that. Again, and David, so to get back to your question, the second key and the number 5 key on your keypad. That is your percent, change in percent key. The old value, 85. Enter, down arrow. New value, 125. Enter, down arrow. Compute, 47.1%. You guys rock. Questions on calculating growth rate. And yes, you will need this for the PA and the OA, just saying. Okay, and here's the solution. We already know that. What is this? What are spontaneous accounts? And this is, we have already talked about it, but just want to make sure we understand what they are, because you might be asked, is this account considered a spontaneous account? So spontaneous accounts, again, the definition is, sorry. That's why Frank said that, and I'm laughing, Sean. Well done. That's why I have a little brain with all this useless information in it. Okay, sorry. Spontaneous account is any account that changes as sales changes. Simple definition. Okay, what is a spontaneous account? Any income statement account is considered a spontaneous account. What about the balance sheet? Well, there are only a couple of balance sheet accounts that we consider spontaneous accounts. Accounts receivables, as we talked about, a current asset. If we sell more, we will bill more, and if we bill more, our accounts receivables will rise. So accounts receivables is considered a spontaneous account. What about inventory? Well, if we sell more stuff, we have to buy more stuff to support the additional sales and additional manufacturing. So inventory is also a spontaneous account. What about accounts payables, which is a current liability? So if we buy more stuff, that means we have to pay more stuff to our vendors, which means our accounts payables goes up. And again, don't worry about accruals right now. So accounts receivables, inventory, and accounts payables are all considered spontaneous accounts because they change as sales change. Questions on that? Let's move on to another incredibly important topic, and one, as I said, that you see a lot in the real world, and that is sustainable growth rate. Sustainable growth rate is defined as the maximum growth rate that a company can have where they don't have to use any additional debt or any additional equity to finance future growth. Well, what does that mean? It is the growth rate in sales that a company can actually do where they have enough capacity and or enough cash so they can purchase the assets that are required to support the growth in sales without having to finance it with debt or equity. That is a really important definition, and it's a really important concept, because what this tells us is this is the minimum growth that we as a company can have without having to write a check to buy equipment using that debt or equity to write that check. So this becomes, from my perspective as a CFO, the floor, the least amount of growth that I should expect without having to get debt or equity to finance any future growth. The sustainable growth rate formula, which is on the formula sheet. See you, Sean. Hey, thanks for coming. We appreciate it. The formula that's on the formula sheet for sustainable growth rate is return on equity times 1 minus the dividend payout ratio. Again, don't need to memorize it. It's on the formula sheet. And here it is. We can calculate return on equity either using the basic equation, thank you, Dr. Frank, or using the DuPont equation. Depends on what the problem gives us. So what does that mean? Okay, we can write it using the DuPont equation, which is here. B, don't forget, is dividends divided by net income. And here it is again using the DuPont equation. Don't have to memorize this. This is just different ways of saying the exact same thing. Yes, ma'am. That is on the formula sheet, as is B, which is dividends divided by net income. So absolutely do not have to memorize this. Memorize the concept. Memorize the approach to solving an SGR problem, but don't memorize the formula, okay? So here is a problem. Let's see how we solve that. Here, of course, my dyslexia got the better of me. NGS, it should have been NSG Corp, has net income of $2.66 million. They pay a dividend of $1.0 million. Sales are $66 million. Total assets are $165.9 million, and total equity is $95 million. What is its SGR? So, again, going back to this formula, it's return on equity times 1 minus B, where B is dividends over net income. So we know that there are two ways to calculate return on equity. And if you remember what I said earlier when we talked about the DuPont equation, if you see net income margin, total asset turnover, or leverage multiplier in the problem, you're going to use the DuPont equation. So the question is, in this problem where we have to calculate return on equity, do we see the net income margin, total asset turnover, and or the leverage multiplier? The answer is obviously no. What that says to us is that we're going to use the basic form of the return on equity formula. And I have a feeling Dr. Frank is going to type that formula for us, which is net income divided by total equity. Okay. Do we have net income in this problem? The answer is yes, $2.66 million. Do we have total equity in this problem? The answer is yes, $95 million. There you go. Thank you, Dr. Frank. Therefore, we can use the formula. Dang, you guys are good. Good job, Jessica. We can use the formula that Dr. Frank has put out there to calculate our return on equity. Again, net income is $2.66 million divided by total equity of $95 million equals 0.0280. As Jessica correctly pointed out, our return on equity is a pretty low 2.8%. Again, what are we comparing that to? I don't know. It's somewhat subjective for me to say it's low, but I did anyway. So that's return on equity. The second part of our calculation has to be B. If you look again in the chat, as Dr. Frank put there, ROE, which we've calculated is 2.8%, times 1 minus B, which is the dividend payout ratio. And again, if you remember, the dividend payout ratio is dividends divided by net income. Do we have dividends here? Yes, 1 million. Do we have net income? Yes, 2.66 million. So let's calculate that. 1 million of dividends divided by 2.6 million, 66 million of net income equals 0.3759. What that says is 37.59% of net income was paid out as dividends. Again, a little factoid that hopefully helps to put this in a different perspective. So now the question is, we have B. Excellent. Dr. Frank makes a great point. We have B, we have return on equity, and we can simply plug and chug into our formula, our SGR formula, to get the total sustainable growth rate. So first we're going to do the 1 minus 0.375, I think it was 0.3759, there's the 2 point, yeah, there it is. 1 minus 0.3759, that's 1 minus B, equals 0.6241. Okay, that's what we keep in the firm, as Dr. Frank points out. 62.41% of our net income is retained in the firm. Okay, multiplied by our return on equity of 0.028 gives us a sustainable growth rate of 1.75%. Again, what this tells us is that the firm can grow at 1.75%, pretty anemic, and not have to purchase any fixed assets or any assets using debt or equity. Questions on the sustainable growth rate calculation, and we're not going to do a second one just because we are running short of time, and I apologize for that. You can download this slide, or this slide deck at the end of the live event, and you can do that extra problem on your own. Questions on sustainable growth rate, concept or calculation? Excellent. All right, we're almost done. We will be done before 10:30. So the last concept I want to talk about, that again is on the PA and the OA, are discretionary financing needed, called DFN. DFN really tells us, after we have forecasted our balance sheet and income statement using percentage of sales, and then we determined how much additional assets we need to purchase to support that growth in sales. The DFN tells us how much do we really need to finance given our assets, our new set of assets, the new equipment that we need to buy, the liabilities that we have, and the equity that we have. Whatever's left, that's what we'll need to finance to purchase the equipment that will be required to support that growth in sales. The DFN formula is also on the formula sheet, and it's an easy one. Discretionary financing needed is assets minus liabilities minus equity. Pretty straightforward, right? So, as we always have, let's do a problem. And again, this is based on a PA problem. Different numbers, same concept. So make sure you understand this, and if you don't, let us know, and we'll do our best to try to demystify it for you. Our forecasted current assets are 120 million. Current liabilities are 80 million. Fixed assets are 450 million. Long-term debt is 200 million, and equity is 140 million. What is our DFN? Total assets minus total liabilities minus total equity. So a problem like this, where we're not necessarily given total assets and total liabilities, we have to calculate it. This implies we need to understand the components of the balance sheet, which is what we talked about earlier in the evening. Total assets are current assets plus fixed assets. So to get our first component, total assets, we need to add together our current assets of 120 million plus our fixed assets of 450 million. So our total assets are 570 million. We need to do the same thing for our current liabilities. Total liabilities, I apologize. Current liabilities are 80 million. Long-term debt, which is the long-term portion of our total liabilities, is 200 million. And that, of course, is 280 million. Equity is already given to us as 140 million. So we simply have to subtract 570 million of total assets minus 280 million of total liabilities minus 140 million of total equity. And that gives us a discretionary financing needed of 150. Excellent, Jessica. That's exactly right. We all came to that conclusion, and that's great. The key here to a DFN problem is they are not going to give you total assets, total liabilities, and total equity. You're going to have to understand the components of the balance sheet in order to put that together. And that's why we did what we did earlier in the class. Questions on discretionary financing needed. And of course, more cute puppies, because that's what I'm all about. Excellent. Okay. So now let me go back to I'm going to stop sharing. There we go. And let me bring in this pod. You can download this pod, download this file, which is this deck that we were just working with, and hopefully that'll help you in terms of going through the calculations. So we are at the end of our live event. What questions can we answer for you? Thank you for your help, Dr. Frank. Very much appreciate it. Dr. Frank and I are usually a comedy duo. He was a little quieter than usual today, but that's okay. He's still the man. Yes, David. I'm just waiting to see what some of the questions are. All right. Thank you again, Dr. Frank. I appreciate all your help. Okay. No problem, David. So let's see. Jessica says, when it comes to the calculations, can we calculate without the percentage? Sure, as long as you remember that it's a percent, and that because the answers will be in percentage form, Jessica. So you want to do it however it makes the most sense to you, as long as you don't get a little bit confused with the decimal point and then find out that you're off by a factor of 100. Let's see, David. Okay, hopefully that made sense, so we're good to go. David says, are the questions on the PA and the OA that include calculations going to have answers that differ greatly? They could. Really, I think, David, what your question is if there's a rounding error or there's rounding in your calculation, will that mess up your answers? And the answer is they should not. Normally, the answers are far enough apart where if you're off by a 0.1, they're not going to say 6.1, 6.0. Normally they don't do that. Yeah, so you guys are good to go from that perspective, because frankly, rounding is a funny thing. So there's no reason for them to try to trick you. I mean, really, the goal here is to test your knowledge, not to trick you. Correct, Nicole. Pretty much any equation you need, other than the ones I mentioned here, will be on that sidebar. Oh, my pleasure, David. Thanks for coming. And I'll talk to you tomorrow. Any other questions that I can answer for you? You're asking great questions. Okay, well, I'm going to stop the recording. And again, I thank you all very much. I'll be here for a few more minutes if you have any other questions. Hopefully this was helpful for you. If you do have questions and you don't want to type them in the chat, let me put in here in the chat what my email address is, and feel free to email me. Please keep it clean. And again, let me know how I can help you. Thanks so much for attending. Please feel free to download the slide deck. And Jessica, you also have a great night. Again, we appreciate you all coming and attending. Good night.